Hey everyone, welcome back. It's Ben Morales, your personal financial coach. Today I'm going to be showing you the 4 steps that you could take ahead of time before you apply for a home equity line of credit. And the reason why I wanted to share this with you is because I'm starting to get a lot of feedback from people that tune into this channel, or perhaps they've seen other channels, or I see this a lot, Facebook discussions. And the question that a lot of people ask is, where do I go to get the home equity line of credit? And so hopefully by the end of this video, this is going to make more sense for you and why you want to have a properly structured home equity line of credit. Because the number one thing that you're trying to create is you're trying to create cash flow efficiency. That is the name of the game. Cash flow efficiency is going to help you more quickly and effectively pay off that debt. So number one is going to be your credit score. It's important, right? It seems obvious, but again, a lot of people, you got to know how the banks roll, right? You're playing by their rules. They're the ones that have the money. So you are going to be asking them for access to that cash in the form of a line of credit. You need to know what credit score you need to have. So typically in this particular case, we're helping this client. This is a very strong credit score right now. 728 is the FICO score of this particular client. So that's already more favorable than someone, say, that has like a 640. Now, I'm not saying that if you have a 640, you would not get approved for home equity line of credit. I'm not saying that. I'm just simply saying that when a lender sees a 640 or under, the likelihood of you getting approved for a very high amount or getting approved at a very good credit score or interest rate is very, very low. So the higher your credit score is to 680 and then above that, the more chances are you're going to be able to get exactly what it is that you're looking for. So that is point number one. Point number two of the top 4 things that you want to know is, what is your LTV, right? That stands for loan to value. And why that's important is because you want to be able to, again, position yourself to get approved the first time around. So the way to figure out what your loan to value is, first of all, it's very easy. You can get into websites like Redfin. You can use Realtor.com. You could also go to Zillow. All of these will give you access to your home. Just put your address, and it'll give you a dollar amount of what either your home or homes around your area are being sold for. So once you know that particular dollar amount, if you don't already know it, that's going to give you a good indication of how much equity that you have available to work with. So in this case, the mortgage balance that's owed is 235, right? That means that there's a huge difference between the value of the home and what the balance is. That difference is 287,000. Now, that doesn't mean that that's what the bank is going to give you access to, right? That just simply tells you what's the difference you have to work with. Now, our target number, and when you're looking for loan to values, you want to be able to stay at an 80% loan to value. And the reason why you want to do that is because when you stay at 80%, a couple of things are going to happen. First of all, you're going to appear to the lender as a lower risk, right? When you start getting close to that 85, 90% LTV, you're going to be a greater risk to the lender, and the likelihood of you getting that is going to stop. It's going to decrease for you. The other thing that's going to do for you is going to make sure that because you are at 80% LTV, that they're going to look at you more favorably, and they're going to potentially give you a better interest rate, especially in a case like this. So 80% LTV from the 522 is actually a total of 417,600. That is our target, right? But she doesn't need the 417,000, but what it will give her access between the 417,600 and 287, there's about $182,000 that she has to work with. So that is our target number. We have a very high potential of a credit line, and now it's just a matter of, we got the credit score, we know what we want to borrow because we did our research on the LTV. Now we're getting closer to the next step. What the next step is, where are we going to go to do this? So we need to find a bank or a credit union. And this is why I say this is how a properly structured home equity line of credit is going to look for you. I always recommend, if you can get your deposit account, okay, and the home equity line of credit at the same bank, it's actually going to work out a lot better for you. So try to do both at the same bank. And here's why. When you're doing this particular rapid payoff method, you want to be able to access your cash flow seamlessly. You don't want to wait days to get cash flow access. You don't want to have interruptions. So when you have a bank account and when you have a home equity line of credit at the same financial institutions, those interruptions should be eliminated, right? The quicker you can move your money from your checking account over to the line of credit, the quicker and more efficient it's going to work for you and put you in a better position to pay off your debt a lot sooner. Now, number 4, this is not all inclusive again, but these are the top 4 things that I thought about when I was preparing to do this video. The last one is going to be review your chargeable expenses, right? Right. And why? You want to move to credit card. You want to know, and this, you might have to do this for 30 days, you might have to do this 60 days, you may have to do this 90 days, but you want to review your bank account, right? Wherever your bank is, what you're trying to find out is how much of your monthly expenses, in this case, 7,520, you can move from your checking account and start using credit cards to pay for those monthly expenses. And the reason why you want to do that is as you're starting to create cash flow for every debt, right? For every debt that you eliminate, essentially you're creating cash flow. You're getting that money that was going toward debt and now it's being retained for you and is being applied as cash flow for you to then re-engage that cash flow into your line of credit. If you can add another aspect to it, right, by moving all your chargeable expenses into a credit card, then essentially for that time period as well, you're adding additional cash flow that would have been coming out from your checking account, and that's being placed into the line of credit as well. And obviously, you're going to have a window between when you use and charge credit to you actually have to payment, which will be in the following month. So it's giving you more access to cash flow, and then you simply deal with that expenses the following month when you have to pay for it. But these 4 things, right, positioning your cash flow in these areas and in such a way is going to put you in a more favorable position, again, to get approved for the line of credit the very first time that you apply. So let me know what you think about this, folks. I definitely want to hear back from you. I want to be able to continue to provide you the value that you're looking for and help answer the questions that I see either on my channel or others' channels or even on Facebook. So hopefully this makes a lot of sense. Thank you for your time and for your support. Until the next video, I will talk to you soon again. Take care and God bless.